Now let's move to share valuation. Ordinary shareholders are residual claimants. They have no claim to earnings or assets until all senior claims are paid in full. They have high risk but historically also high return. As with bonds, the value of shares depends on future cash flows. However, these cash flows sometimes are not of equal value. And because these cash flows or dividends distributed from share investments are not equal, there are special models that can be used to value shares. One of these models, dividend growth model, is widely used in finance. We know that, like bonds, the cash flows from share investing are made up of dividends and sale proceeds if you sell the shares. However, unlike bonds with shares, both the dividends and sale proceeds are uncertain. Remember, with bonds, we knew what the coupon or the interest payment was every period. And we also knew that we'll get the principal back when the bond matures. With shares, we don't know what the dividend company will declare next year, let alone in 5 years. And we wouldn't even dare to guess what the share price will be in 5 years' time. The other issue is that unlike bonds who have a definite life, a term to maturity, shares have an indefinite life. These are the two issues in valuations of shares that are very important: uncertainty of cash flows and indefinite life. The only thing that is common with bonds is that the price of a share is calculated as the present value of future cash flows. So to state it again, the price of a share is the present value of its future dividends plus the present value of selling price if we decide to sell the share. If we have a share and decide to sell it in 1 year's time, then the price today would be the present value of its dividend received during the year and the selling price in a year's time. Or if we want to sell the share at the end of the second year, again, the present value of the share today would be the present value of the dividend received in year 1 plus the present value of dividend received in year 2 and the selling price when we sell it in year 2 and so on. Or if we don't want to sell, the price today would be just the present value of those future dividends to be received. We might want to sell but don't know when, or just want to leave the share to our children or grandchildren. How are we going to estimate all these future cash flows indefinitely in the future in order to find the current value of a share? We estimate these cash flows by simplifying the assumptions regarding the pattern of dividends. There are 3 cases to be considered. In the first instance, there is no growth in the cash flows. The firm pays the same amount of dividend each year indefinitely. Sounds familiar? This is again like preference shares, and the price is calculated using the perpetuity formula. In the second case, the dividends are growing, but they are growing at the same rate or constant rate. So the rate of growth is constant, not the dividend. The third case is where the dividends have a period of variation in growth, after which the rate settles to a constant level. We'll have a look at each case now with some examples. Now in the case 1, if the same dividends are expected at regular intervals forever, then such shares are considered perpetuities, and the present value of expected future dividends can be found using perpetuity formula. So, suppose investors require an 11% return on the preference shares that pays a $2.30 annual dividends. What would be the share price of this investment? We apply the formula of perpetuity and we find that the price per share in today's money is $20.90. Preference shares have some features similar to debt and other features similar to equity. They promise a fixed amount of dividend payment, though this is not legally enforceable. Their claim on assets and cash flow rank senior to ordinary shares. Also, preference shareholders usually do not have voting rights. In the second scenario, the assumption is that the company's dividend per share will grow at a constant rate of G. So dividend in year 2 will be greater than dividend in year 1, and so forth and so forth. We know that the value of an investment today is the present value of future cash flows. In the same manner, we say the price of a share today is the present value of future dividends. That's what the formula says. It discounts each year's dividend to the present. Reducing this long formula that never ends, we have the square formula in the square, which says price today is equal to D0 multiplied by 1 plus G divided by R minus G. This is also equal to D1 divided by R minus G. This is also called the dividend growth model, or the dividend discount model, or Gordon's model. For that matter, using this model, we can calculate the share price at any point in time. For example, if we want to find the price in year 3, we just find the dividend in year 4 and divide by R minus G. Or if we want to sell the share in year 5, we calculate D6 and then divide by R minus G. Future dividends can be calculated using two methods. So in every case, you will always know a dividend, either the one just been paid or the future or the proposed dividend for the next year. So this means that we can always calculate a certain dividend by multiplying it by 1 plus G. For example, if you know D0, you can calculate D1 as D0 times 1 plus G. Or if we want to calculate a dividend in any period in the future, it can be calculated from the initial dividend multiplied by 1 plus G at the power of n. For example, D4 can be based on the previous one, D3, compounded growth for one more period. Or if we have D0, D4 can be calculated based on that original dividend multiplied by 1 plus G, compounded for 4 periods. These are simple examples showing how to apply this dividend growth model. So let's look at the first example. Suppose Big D Incorporated just paid a dividend of 50 cents. It is expected to increase its dividend by 2% per year. If the market requires a return of 15% on assets of this risk, how much should the share be selling for? So note that here we have given D0, the dividend that just has been paid. The growth rate is 2% and the interest rate is 15%. We apply the model and we find that the price per share is $3.92. In the second example, the company is expected to pay a $2 dividend in 1 year. If the dividend expects to grow at 5% and the return is 20%, what is the share price today? We apply the formula again and find the share price to be $13.33. Now, why haven't we multiplied the dividend by 1 plus G in this example? The reason is that here we are given D1, the expected dividend in 1 year. So here D1 is already calculated for us. So we don't need to multiply it by 1 plus g. It's already in the future. So do not make a mistake in these calculations by paying attention at the problem where it says just paid or is about to pay versus expected to pay in the future. Note that in this example, again, we are given the expected dividend for the next period, D1. So Golden Growth Company is expected to pay a dividend of $4 next period, and dividends are expected to grow at 6% per year. What is the current price if the return is 16%? Easy, we apply the formula, the simple one, and find the price to be $40. The next question asks, what is the price in year 4? Remember we said we can use the model, the same model, to find the price sometime in the future, if we decide in the future. So to calculate the price in year 4, all we need is the dividend in year 5, based on dividend in year 4. But we don't have D4. However, what we have is D1. And as long as we have a known dividend, we can calculate any future dividend with the help of G, the growth rate. Therefore, the dividend in year 5 is D1 compounded for 4 periods using the growth rate. Once we know this future dividend, D5, we use the Gordon model to find the year 4 value, which is $50.50. Note that the dividend in the numerator is always greater than 1 period than the price we are trying to find out. This is because we are calculating a present value, so we start with the future cash flow. This is very important when we discuss supernormal growth. The last question asks, what is the return? What is the implied return given the change in price during the 4-year period? By looking at the figures, what do we have? We have the price today, or the present value, of $40, and we have the price in year 4, or the future value, the $50.50. And also we have the number of periods, 4 years. The only thing we don't know is R. And using algebra, we can isolate R from our equation to find that R is 6%. Please do the calculation to check that you get the same answer. Note that the price grows at the same rate as the dividends, which is not so surprising. If the cash flow on an investment grows at a constant rate throughout time, so does the value of our investment. Now take time to do these 2 questions. The first one, the company pays a dividend of 32 cents. Investors expect that the dividend to remain constant forever. And the investors require a 10% return. What is the share worth today? So here we see the dividends being constant forever. That's like a preference share, and we said we value these preference shares using the perpetuity formula. In the second example, the share starts to pay dividends that grow at 3% per year. So in this second example, we apply the case 2 scenario where we value the share using the dividend discount model. So the first answer is $3.20 and the second answer is $4.57. In the third case of share valuation, we have dividends that grow at multiple rates. The valuation follows the same principle. present value of future cash flows or dividends. However, these dividends must be calculated using their respective growth rates. In general, variable growth model is applied on startup firms who experience a period of supernormal growth initially, after which they settle to a constant growth rate. For example, suppose a firm is expected to increase dividends by 20% for the next 3 years. After that, dividends will increase at a constant rate of 5% per year, indefinitely. If the most recent dividend was $2 and the required return is 14%, what is the share price today? The first step to do is to calculate the value of future dividends depending on their growth rates. Once the rate becomes constant, we can apply case 2 of share valuation to find the share price at that moment in the future where dividend growth rate becomes constant. This will take care of all those indefinite future dividends from that point onwards. Lastly, we calculate the present value of all cash flow, dividends, and future price and add them together to find the current share value. So using this example, the first step we do is to calculate those dividends based on the first growth rate of 20%. So this 20% growth rate is applied only for the first 3 years. So then we calculate first D1, $2 multiplied by 1.2. D2 is based on D1, $2.40 multiplied by 1.2. And D3 is based on D2, $2.88 multiplied by 1.2. Then in year 3, the growth rate changes to 5%. And we use that growth rate to find D4. So based on D3 of $3.46, we multiply by 1.05, the growth rate in year 3, and we find the dividend in year 4. The only reason we find D4 is to calculate P3 using the case 2 model when growth rate becomes constant. So P3 is D4 divided by R minus G. In other words, $3.36 divided by R, 14%, minus G, 5%. And that's the value of the share in year 3, $40.33. Now we have all the cash flows and we discount all 4 cash flows based on just the required rate of return of 14%, noting that the 2 last cash flows occur in the same year, in year 3. Overall, we find the result, the price today is $33.89. A note on the components of the required rate of return. The required rate of return is the minimum rate of return required to undertake an investment. Alternatively, it is also the cost of capital for a project. Rearranging the formula of our dividend discount model, we can see that R is made of dividend yield and the capital gains yield. And the capital gains yield is just the growth rate, the rate at which the value of investment grows. Remember, in a previous example, we found out that share value grew at the same rate as the cash flows. This R that we derive based on the current market price and dividend and growth rate is also known as the required or implied return of the stock. Based on what the market or investors valued the share, this is their implied return. This is useful when comparing it with the expected return to determine whether a share is over or undervalued. For example, suppose the firm's share is selling for $10.50. So this price is currently known in the market. We can observe this price in the market. The firm just paid a $1 dividend, and dividends are expected to grow at 5% per year. What is the required return? In other words, what is the implied return based on this current market price? So first of all, remember we have to calculate D1 because the model requires the future dividend, not the current dividend, not the zero, the dividend that just has been paid. So first we take $1 and multiply it by 1.05, and then we perform the calculation, and we find that the implied return or the required return is 15%. What is the dividend yield? The dividend yield is just D1 divided by the price, 10%, and the capital gains yield we know from the start is just G, or to make sure, the required return minus the dividend yield, 5%. Now, in all these examples, we're given G, the growth rate. But who says that the growth rate in dividends is 5%, for example? Who came up with that number? In practice, we also have to estimate the growth rate. How do we do that? One method of estimating the growth rate is using the historical data by calculating the average growth rates of dividends, sales, earnings, etc. Based on what the dividends were in the past, we can calculate each year's growth in dividends. Once we have each year's percentage change or growth in dividends, we take the average to give us an overall growth rate, an estimated growth rate, as we have in the table, average growth rate of 5.1%. Another way is to use the information from the financial statements by determining the retention rate and the return on equity, and then take the product of the two. This is called the retention growth model. For example, in 2010, PHP Billiton reported net income of $243 million. Total shareholders' equity was $1,602 million, and they paid $32 million in dividends. So first, we calculate the return on equity, and we already know how to find this ratio. So net income divided by shareholders' equity is 15.2% return on equity. To calculate the retention rate, first we find how much proportion has been paid in dividends, or the payout ratio, as being given by dividend divided on shareholder equity. So in our case, the payout ratio is 13.2%. This is what we pay. Therefore, what we don't pay, we retain. So the rest we retain. So the retention rate, RR, is 1 minus the payout ratio. So therefore, the retention rate is 1 minus 13.2% equals 86.8%. Using this number and the return on equity, we find the growth rate as RR multiplied by ROE equal 13.2%. Another way to find out growth rate is the market consensus estimate, where we look at what the analysts have forecasted and take an average of all their forecasts. This is how share prices are quoted in the market. What we have here is a quote for Coca-Cola Company. First, we have the highs and the lows as measured for the last 52 weeks or last year, and the highs and the lows of the previous day. Then the code CCL, the ticker, then the company name, and the last sale price of the day of $12.68. Then we have the column which says 1 or 2. 1 stands for positive price variation and 2 stands for negative change in price. What we have here is a 2, meaning that the price dropped by 18 cents from previous day. Then the quote shows the volume of shares traded and the actual quote of bid and ask, or buy and sell. The buy quote is $12.67, so the market buys at that price, and the sell quote or the ask quote is $12.68. As an investor, if you want to buy Coca-Cola, you look at the ask or the sell. What is the market selling for? And if you want to sell, if you already own Coca-Cola and you want to sell it, and you want to see how much it sells in the market, you look at the bid or the buy. What is the market buying for? Then we have information about the dividend. We have a 52.5 cents per share dividend with the capital F beside it, which means the dividend is fully franked. If the F is small, it's in lower cap, it means the dividend is partially franked. The next column, times covered, is calculated as earnings per share divided by the amount of dividend. In other words, 70.2 divided by 52.5. And means how many times the dividend has been covered by earnings. The next column, net tangible assets, NTA, means that if the company would be liquidated today, this is what investors would get. Net tangible assets per share, $1.64 per share. Then we have information about the dividend yields, which we just found out how to calculate the dividend divided by the share price. And in this case, we use the last sale price. So 52.5 divided by 12.68, we would get a 4.2% dividend yield. The earnings per share, which is given, remember we said this is a very important information for investor, along with the PE ratio, another important ratio. PE, price, the last sale price, 12.68, divided by the earnings per share, 70.2, and we have a PE ratio of 17.84. What if the company doesn't pay any dividends? It means we cannot value the shares using our discounting cash flow methods and must use other approaches, such as the free cash flow approach. The free cash flow is the net amount of cash remaining after the company has met all operating needs and paid for investments, both long-term and short-term. It represents the cash amount that a company could distribute to investors after meeting all its other obligations. So once we estimate the free cash flow, we discount them using the company's cost of capital to arrive at the total value of the firm, the company. Then we subtract the value of the debt and the value of preference share to obtain the value of shares. Then we divide this value of shares by the number of shares outstanding to arrive at the price per share. The second approach is the book value approach, where the value of a company is the value recorded in the balance sheet. And the other approach, the liquidation approach, is where the value of the company is the amount of cash that remains after the assets are sold and liabilities are paid. And the last approach, the comparable market multiple approach, is widely used by analysts as a secondary valuation technique to the discounted cash flow techniques. In this method, similar companies as the firm we want to value are selected and their PE ratios calculated. Then we take the average of all those PE ratios and multiply it with the earnings of the company we want value. And that way we get a value for our firm, which then we divide by the number of shares outstanding to find the value per share. Here we differentiate between debt and equity, as sometimes corporations issue exotic hybrid securities to take advantage of the best of both worlds. If we look at the two sides and considering the issues of ownership, voting rights, taxation, legal liability, and insolvency or bankruptcy, we see that they are opposite. What managers are looking at when considering whether to issue debt or equity is tax and liability issue. To suit their own agenda, companies might want to consider issuing securities as debt so they can deduct the interest. At the same time, a company might want to treat a security as equity because dividends are not liability as interest is, so they don't have to pay dividends. This concludes this module.